Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive.
We have a really interesting one today.
Today, we're breaking down a company that is quite literally foundational to the digital world. It's often mistaken for just a simple real estate play.
It's so much more.
We're looking at what is essentially the ultimate global switchboard for the entire internet, the digital infrastructure giant Equinix.
On the surface, it's a fantastic business with a powerful, almost monopolistic position in certain markets. But the real question for us as long-term investors is this. Are there hidden cracks in the fortress that the market is ignoring?
That's what we're here to find out.
That's a massive question. And before we get into the details, just a quick note for everyone watching.
For those who want to act on these investing ideas, having a professional-grade platform is key. We use Interactive Brokers, and we've partnered with them to get our viewers a stock bonus when they sign up.
So they get a bonus and support the channel at the same time? That link is in the description, right?
That's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to get the next one is to subscribe and like the video. It truly helps the channel. And if you have any questions regarding the company, please manifest yourself in the comment section.
Perfect. Now let's get into it. Pillar number 1, the business model. Where do we even start with this one?
Well, I think we have to start with the basics because you mentioned it before we started. The category error here is just, it's fundamental to understanding the whole thesis.
It really is.
It's listed as a REIT, a real estate investment trust.
Mm-hmm.
So you hear that and you immediately think landlord. You think of, I don't know, shopping malls or office building.
Or just big metal warehouses. And you're not totally wrong on the surface, but if you stop there, you completely miss the point.
You miss the entire economic engine. Thinking of it as a traditional landlord who just, collects rent on a building misses the entire value proposition.
Wow.
It misses what drives their insane margins and their customer stickiness.
Precisely. If you only value the land, the buildings, you're valuing it like a self-storage facility. But the value is not the concrete. The value is what happens inside those buildings. It's fundamentally a global switchboard.
A physical meeting place.
The physical meeting place for the digital economy. We've called it the world's most crucial, neutral, interconnected hotel where digital assets check in, but they never, ever want to check out.
Okay, so let's break down that business model because it really reveals why it's not just a landlord. There are two core revenue streams, and understanding the difference between them is the key.
Absolutely. It's the key to the margin structure and, more importantly, the economic moat.
Let's start with the simple one, the one that makes it look like a REIT, the rent.
Right, so that's colocation. This is the foundational piece. It involves the monthly fees they charge to their customers, and that can be anyone from a massive cloud provider like Amazon Web Services to a single enterprise bank.
And what are they paying for?
They're paying for physical space, power, and cooling. That's it. They're renting a specific cabinet or a rack inside a massive, hyper-secure, climate-controlled server room to house their own servers and networking gear.
So this is the part that's heavy on capital expenditure, right? You have to build the building, put in the cooling.
Exactly. It's the high capex, lower margin, baseline revenue. It's absolutely necessary, but, it's not the magic. It's not where the real value is created.
Okay, so if colocation is the baseline, where does the real value and those premium tech-like margins come from? This is the toll road analogy.
That is interconnection. This is the secret sauce. This is the high margin differentiator and, frankly, the engine of the premium valuation the market gives it.
And what is it exactly?
Interconnection is the recurring fee they charge for physical and virtual cables. They're called cross-connects that literally link one customer directly to another customer within the same building.
So it's not about connecting to the outside world, it's about connecting to your neighbors inside the hotel.
That's the perfect way to put it. This is where the massive value exchange occurs, and is where the economic moat is born.
We really need to put a spotlight on that margin difference because that's what separates Equinix from almost all its peers.
It's night and day. Colocation, as you said, requires constant capital. You buy land, build the facility, install cooling, pay for power. The margin, while it's healthy for a real estate business, is constrained by all those physical costs.
Okay.
Interconnection, on the other hand. Once that little fiber optic cable is run from one rack to another and the connection is established, it's essentially 100% gross margin.
Wow.
They just sell a new digital pathway, and that recurring monthly fee flows straight to the bottom line with almost zero incremental cost. This dramatic margin profile is why the market values this company more like a fast-growing software company than a traditional REIT.
Can you give us a concrete example, one that really illustrates how critical this high-value interconnection is for a customer?
Sure, think about a big content delivery network like Netflix. They need to get their video streams to customers who use, say, Verizon for their internet.
Okay.
Now, Netflix could send that data out over the public internet, which is slow, it's congested, it's unreliable, you get buffering.
Hmm.
Or they can rent a rack inside an Equinix data center right next to a rack rented by Verizon.
And then they pay Equinix for a cross-connect.
Exactly. They pay Equinix a recurring fee for a direct private fiber connection between their servers and Verizon's network.
Right.
It completely bypasses the public internet. It ensures speed, security, reliability. For Netflix, that speed and reliability is a non-negotiable part of their product. They have to pay for it.
And that simple distinction, renting space versus selling connections, that underpins the entire economic moat. The value isn't the concrete, it's the density of all those interconnected tenants.
It's all about the density.
And this is where it gets really, really interesting. Let's talk about that primary moat, the network effects and the tyranny of latency.
Right. Latency, which is just the speed of data transfer, is, well, it's everything in the digital world. Equinix's moat is built entirely on classic network effects.
The more people who join the network, the more valuable it becomes for everyone.
Exactly. The more customers, and more importantly, the more critical connections and ecosystems that a single data center has, the more valuable and critical that location becomes for every single new customer who wants to join. It's a powerful, self-reinforcing, two-sided market.
And the most compelling, almost absurd example of this is in financial services, high-frequency trading.
Oh, absolutely.
Yeah.
This is where speed moves from a nice-to-have to a, multi-million-dollar financial imperative.
So walk us through that. Why is it so extreme there?
Let's use the high-frequency trading firm example again because it just shows the obsession with speed.
Yeah.
These firms must co-locate their trading servers in a specific facility, like Equinix's NY4 campus in the New York area.
Not just in the same city, but in a specific building.
A specific building. Why? Because that facility is physically the closest one to where the major exchanges, like NASDAQ, house their matching engines, the computers that actually execute the trades.
So it's about physical proximity.
It's purely about physics.
Yeah.
We are talking about firms that measure the physical length of the fiber optic cables connecting them to the exchange. They measure it in feet, not miles. If your server is even a few meters further away, the speed of light dictates that you suffer a nanosecond delay.
And in high-frequency trading.
Microseconds are literally millions of dollars in missed arbitrage opportunities. It is an arms race for proximity, and Equinix owns the finish line.
So it creates this self-reinforcing cycle, almost like a magnetic pull or gravity. The exchange sets up shop there.
Right, and that forces the Tier 1 banks like Goldman Sachs or JP Morgan to come because they have to trade with the exchange.
Then what happens?
Then the specialized market data providers, like Bloomberg, have to come because they need to deliver real-time pricing data to the banks. Everyone who is critical to that ecosystem ends up in the same room, paying rent and interconnection fees to Equinix.
It's an economic flywheel that seems, almost unbreakable. Once a single Equinix building achieves that level of ecosystem density, it contains all of the most desirable counterparties. No competitor can easily replicate it.
It's almost impossible. The cost of building a competing concrete building is high, sure, but that's not the real barrier.
The real barrier is getting everyone to move.
The real barrier is convincing every single one of those critical financial players, cloud providers, and carriers to move their incredibly complex interconnected IT stacks from Equinix to your brand new empty building. It's a non-starter. That density is the ultimate barrier to entry.
And what's just incredible is that this moat, it seems to be widening, not shrinking, especially with this explosion in artificial intelligence.
AI is the major secular tailwind right now, and it's just reinforcing Equinix's position at the core of everything. You see, AI workloads, they require two things: massive, centralized power for training the models.
Which is more of a wholesale data hall business.
Correct, but they also require immense speed for inference.
Okay, let's clarify inference for everyone listening.
Inference is the process of actually using the trained AI model on new data to generate a real-time output. Think of ChatGPT answering your question or a self-driving car reacting to a pedestrian. That's inference.
And that has to be fast.
It has to be instantaneous. So if you're a global bank using an AI model to detect fraud in real time, you need that processing to happen right next to your corporate transaction data, which is probably already sitting in an Equinix facility.
You can't have the data traveling across the country and back.
You can't. You need the CPU to drink directly from the data fire hose, not wait for the water truck to arrive. This drives immense demand for edge computing and low-latency interconnection, which just reinforces the gravitational pull of their existing dense facilities.
It's a perfect real-world application of some of these mental models we talk about. Well, let's connect this explicitly to Metcalfe's law, because that explains how they get away with charging such a premium.
Yeah, Metcalfe's law states that the value of a network is proportional to the square of the number of its connected users.
Yeah.
So, if Equinix adds one massive new tenant, like AWS, to a facility,
It doesn't just add one unit of value.
not at all. It doesn't just add one unit of revenue for the rent they pay. It exponentially increases the value of that entire location for every single enterprise customer already in that building who needs a high-speed, direct, and secure connection to AWS.
The whole ecosystem benefits.
The entire ecosystem becomes more valuable. And that allows Equinix to monetize that exponential value increase through premium pricing for their connections and through annual price escalators. They capture the value created by the network, not just the concrete.
And if that network effect isn't a deep enough moat, there's the sheer practical pain of leaving. We call it the Hotel California effect.
Right. You can check out anytime you like, but you can never leave. It's the switching cost moat in its purest, most brutal form.
Just how painful is it to move?
Moving a substantial data stack is the absolute nightmare scenario for any IT manager or CIO. It involves, not just the logistical difficulty of physically moving hundreds of servers, the risk of hardware damage, the cost of labor and trucking, but the operational risk, the risk of downtime.
And that operational risk is the real killer, isn't it?
It is. For a global financial firm, for a major airline, for a large retailer, even 1 hour of unplanned outage or business interruption can cost millions of dollars in lost revenue and cause irreparable damage to their brand.
But the final nail in the coffin is the complexity of all those cross-connects you mentioned.
That's the one. If a company's been a tenant in an Equinix facility for 5 or 10 years, they likely have hundreds of these physical and virtual cables connecting them to their specific partners, carriers, suppliers, and customers within that same building.
It's a web of connections.
It's a delicate, intricate web of physical contracts and high-speed relationships. Replicating that entire web in a brand new facility somewhere else is an immense, risky, and expensive undertaking. So the risk of switching is far, far higher than the cost of just absorbing Equinix's annual premium price increases.
So their economic power comes from the fact that once you're in, the pain of leaving is simply too great to justify it. You're effectively locked in.
It creates incredibly sticky, highly recurring revenue.
Yeah.
The customer might complain about the price, they might grumble, but they will pay it because the alternative is to risk their entire business. This stickiness translates directly into the financial resilience we'll talk about later.
Okay, so let's quickly touch on the competitive landscape. I mean, Equinix isn't completely alone in this space. You have Digital Realty, Cyrusone, CoreSite. They're all major players. How do they stack up? What is the defining competitive edge Equinix has?
The landscape is largely defined by strategic focus. Digital Realty, or DLR, has traditionally been focused on wholesale colocation.
So does that mean wholesale?
It means they rent massive halls, or sometimes entire buildings, to a single, very large tenant. Often a hyperscaler like Microsoft or Amazon, who then runs their own internal network inside that space. It's a high-volume business, it's extremely capital-intensive, and it's lower margin.
And Equinix, by contrast, is retail.
Exactly. Equinix has historically dominated the retail interconnection side. They rent out individual racks and cages to thousands of different interconnected tenants, the banks, the carriers, the enterprises.
So what's the core advantage there?
The defining Equinix advantage is interconnection density and neutrality. So while a company like DLR might actually have more total square footage of data center space globally, Equinix has vastly more mission-critical connections and a reputation for being the truly neutral meeting point.
That neutrality piece seems critical, especially when we talk about the big clouds. Why would AWS, Microsoft, and Google all agree to put their gear in an Equinix building, but maybe not in a building owned entirely by one of their rivals?
Well, you've hit on the entire point. Equinix serves as the Switzerland of data. Enterprises trust that Equinix will treat their traffic going to AWS exactly the same as their traffic going to Google Cloud. It ensures competitive fairness and operational independence.
There's no fear of favoritism.
None. If Google owned the physical building where Amazon needed to connect to its enterprise customers, there would always be a fear of, unfair competitive practices or prioritized traffic Equinix guarantees that neutral, essential ground, which makes it indispensable to everyone, including the hyperscalers themselves.
So the mental model here is something like, if you need to store huge amounts of bulk, less critical data on the cheap, you might look at a wholesale provider.
Mm-hmm.
But if you need to execute high-speed, mission-critical transactions where speed, proximity to partners, and neutrality all matter, you go to Equinix.
That is the perfect encapsulation. It is the premium location for transaction speed and trusted connection. And this is why the customer perception data, the reviews, are so instructive.
I was looking at those reviews on places like Gartner and TrustRadius, and the feedback is just astonishingly consistent. What's the good and what's the bad?
The good, the love, is all about reliability and that ecosystem density. Customers universally praise what they call the 6 nines uptime record. That's 99.9999% availability. These facilities simply do not go down, which is absolutely crucial for financial applications.
And the ecosystem part.
They acknowledge that if you need to be connected to the most diverse range of carriers, partners, and public clouds in any given major city, Equinix is the only game in town. It is best in class, period.
But the universal negative, the pain point, is clearly the price.
Yes, without fail. The company is universally described as the premium option. It is expensive to get in, and customers complain that it's even more expensive to expand. So when you need more power or more space, the price increase is steep.
And they pass on costs.
Oh yeah, they raise prices annually. They charge significant fees for every little added service. But, and this is the crucial part, the crucial coda to that complaint is that the service is almost always deemed necessary.
So they complain, but they pay.
They complain, but they pay the premium because the alternative, which is switching, is seen as catastrophic. It's the ultimate evidence of real pricing power derived from that impenetrable moat.
All right, let's shift gears. Let's look under the hood at the management team and the financial structure. Because even the best business model in the world can be run into the ground by poor capital allocation.
And this is an area where Equinix has generally shown remarkable discipline in how it invests its capital.
Let's start with the recent leadership transition, because I think that signals a really clear strategic direction for the company. There's been a shift with Adaire Fox-Martin taking over as CEO, succeeding Charles Myers. She came from a major cloud background. What does that signal to the market?
It signals a clear and I think accelerating strategic pivot toward platform services and deeper integration with the hyperscalers, but not just by selling them more space.
Right, she came from Google Cloud.
She came directly from a very senior role at Google Cloud. This choice emphasizes that the future of Equinix isn't just about leasing physical racks and cages anymore. It's about becoming the facilitator of virtual connections, of software-defined interconnection, like their Equinix Fabric product in bare metal services.
They're moving up the value stack.
They are moving up the value stack. They're leveraging their physical assets, their physical density, to sell higher margin digital products on top of it. It's a very smart evolution.
So they're trying to monetize that installed base, not just with rent and cross-connects, but by turning it into a platform for digital services.
Exactly. They're digitalizing the physical handshake. And what's really crucial here is that management's incentives are aligned perfectly with prudent stewardship.
Oh.
Executive compensation is heavily tied to growth in a metric called AFO per share. That's adjusted funds from operations per share.
Which is the gold standard for REITs.
The gold standard means management is incentivized to increase the actual cash flow available to shareholders on a per-share basis, not just to engage in, empire building.
Right, not just growing revenue for the sake of getting bigger.
Exactly. It prevents them from just growing square footage, regardless of the return on that invested capital. They're focused on quality cash flow per share, which is what you want to see as a long-term owner.
And that discipline leads us directly to what I think is the management masterstroke of the last few years, the X-scale joint ventures. This is such a critical concept for understanding why Equinix has been able to remain a high-quality, high-return company.
The X-scale decision is, it demonstrates a level of capital allocation genius that you rarely see in the infrastructure world. It's brilliant.
So break it down for us. What was the problem they were trying to solve?
The problem was the hyperscalers, Microsoft, Google, Amazon. They need these massive, giant facilities, often called mega campuses, to handle their relentless growth. But these huge facilities are also very low margin compared to Equinix's core retail interconnection business.
And they require a ton of upfront capital.
Immense upfront capital. So the traditional REIT behavior would be to see that market share, lever up the balance sheet, and build those facilities themselves, sacrificing returns just to say they have the most revenue.
The empire building you mentioned.
Right. But Equinix leadership, they looked at that and they realized that building these low-margin, massive-scale facilities using their own high-return balance sheet would drastically dilute their overall return on invested capital. It would be a terrible use of shareholder money.
So if your core business is generating, say, a 30% yield on cost, why would you spend that capital on a project that might only generate a 3.5% return?
You wouldn't. It's terrible capital allocation. So the solution was the xScale JVs, or joint ventures.
They essentially said, we want the hyperscaler as a customer, and we want the high-margin connection business that comes with them, but we don't want to use our best capital to build the low-margin concrete box for them.
Precisely. They went out and brought in partner money, often from massive long-term investors like sovereign wealth funds and pension funds, who were happy to take on the capital risk for the wholesale build-out in exchange for stable long-term returns.
So how does the structure work?
The structure is elegant. Equinix uses this partner money to build the wholesale xScale facilities that are primarily dedicated to the hyperscalers. And the result is beautiful for Equinix shareholders.
They get the best of both worlds.
They do. Equinix still earns robust management and performance fees for building and operating the facilities. They maintain influence over the physical asset. And most importantly, they get to keep their own precious, high-return capital focused squarely on the retail colocation and interconnection business that defines their moat. It's a strategic separation of capital and risk.
It's the ultimate test of rationality. They refuse to dilute their best business just for the sake of top-line revenue growth in a commodity segment.
It's a textbook example of disciplined capital stewardship. They prioritize the quality of their ROIC over the gross size of their revenue. That's a rare and extremely high-quality management trait.
Okay, let's look at the financial fortress itself now. When you dig into the numbers, what really stands out about the resilience and the consistency of this business?
Predictability.
Yeah.
That's the key word. And you can see it in two primary metrics. First, their adjusted EBITDA margins consistently hover in a very tight, very healthy range. We're talking 45% to 47%.
That's incredibly stable.
It is, especially in an industry that's so dependent on massive upfront CapEx. That stability just speaks to the underlying strength of their pricing power and their operational efficiency. But the second metric, and maybe the most remarkable one, is the recurrence of their revenue.
Which is just astronomical for a business that owns physical assets.
It's consistently over 95%. Think about that. Year after year, 95% of their revenue comes from existing customers paying their existing contracts.
That's a number you usually only see in the best software as a service companies.
Exactly. The highest quality, most entrenched SaaS companies, not physical infrastructure. And this makes the business highly predictable, even in volatile markets, which further justifies that high premium valuation because investors can model future cash flows with a really unusual degree of certainty.
Now let's tackle the financial ratios, because this is the primary area where new investors fall into what you call the ROIC trap.
Yeah.
If you just look at a standard return on invested capital, or ROIC, it looks quite low, typically in the 3.5% to 4.5% range. If the returns look that weak, why are we calling this a financial fortress?
You're hitting on the core misconception about investing in this kind of infrastructure. The standard ROIC formula is heavily skewed or distorted by two factors that are unique to data centers: massive front-loaded depreciation and constant expensive upfront capital expenditures.
Okay, so unpack that.
When a data center is built, the concrete shell might last for 50 years. But the equipment inside, the cooling systems, the power infrastructure, that has to be refreshed every 5 to 10 years to stay competitive.
And accounting rules make them write that down quickly.
Right. GAAP accounting rules require them to depreciate those large assets quickly, which artificially depresses their reported earnings and therefore the ROIC number that spits out of the formula.
So the formula is basically penalizing them for constantly investing to stay on the cutting edge inside a long-life building.
Exactly. It doesn't capture the longevity and quality of the cash flow stream once that asset is stabilized and full. So it's not the right metric to use.
So what's the better proxy? How should we be thinking about the true economic returns of their assets?
You need to look at the yield on cost for stabilized assets. This metric looks at the annual cash flow generated by a facility once it's fully leased up and mature, and it compares that to the total cost to build it.
And for Equinix, that number is?
For Equinix, this internal yield on cost often exceeds 30%.
Wow, that's a completely different picture.
It's a totally different picture. Think of it like building a hotel. You spend billions up front, you have zero revenue until it opens, but then, For decades, that asset generates massive, stable cash flows. The 3.5% ROIC is the number you see in year one. The 30% plus yield on cost is the number that represents the true return quality over the life of that asset. That's the sign of an exceptional business.
That provides some crucial context. Okay, finally, the balance sheet. They are a REIT, so they use debt. Their net debt to EBITDA ratio typically sits between 3.7 times and 4.5 times. Now, for a regular tech company, that level of leverage would be alarming. How should we contextualize that debt load?
It's all about asset quality and the predictability of cash flows. While yes, 4 times net debt to EBITDA is undeniably high for a standard software company, it is prudent and standard for a top-tier investment-grade infrastructure REIT like Equinix.
Because the debt is backed by hard assets.
It's secured against tangible, essential, incredibly durable physical assets that have near guaranteed cash flow streams, thanks to that 95% plus recurring revenue. Their cash flow stability basically acts as a guarantee for their debt service, so they operate well within their investment-grade credit rating, and the market recognizes the high quality of the underlying collateral. They're leveraging a fortress, not a shaky venture.
Okay, we've established it's a high-quality business, great moat, disciplined management, durable revenue. Now we hit the final hurdle, the thing that always divides investors, valuation. The premium problem.
It's the perennial challenge with this name. Equinix historically trades at a premium multiple, usually somewhere between 20 and 28 times price to AFO. Your typical REIT peers might trade in the low to mid-teens.
And why does the market give it that premium?
For two main reasons. One, its pace of growth is significantly faster than traditional real estate. And two, that tech-like stickiness we talked about, that high recurrence rate, it minimizes the perceived risk for investors.
So if it's almost never cheap in a traditional sense, where does an investor find a margin of safety? It's certainly not from buying it for less than the cost of its assets.
No, absolutely not. For a company like Equinix, the margin of safety is found in timing, not in deep intrinsic undervaluation. Safety comes from buying when the multiple temporarily compresses due to some overarching macro fear.
Like rising interest rates.
Exactly. When rising interest rates punish all REITs indiscriminately, regardless of quality. When those external factors, not an erosion of the actual business, drive the price down, that's your window of opportunity. Historically, an entry point near that 18 to 20 times AFO range has proven to be a pretty strong floor and offers a compelling margin of safety.
So what does this all really mean? It sounds like the core difference between identifying a wonderful company, which this seems to be, and making a wonderful investment is determined entirely by the price you pay.
That's it exactly. If you buy at the high end of the range, say 35 times AFFO, you are essentially demanding decades of absolute perfection. You need maximal growth, no strategic missteps, just to generate a satisfactory return.
And if you buy closer to the floor,
If you buy near that 20 times AFO floor, the reliable growing dividend plus the mid to high single-digit organic growth gives you a much clearer, much more forgiving path to double-digit compounding returns. The quality isn't the question here. The price you pay determines your entire risk and return profile.
okay, so let's look at the primary growth engine that the bulls are banking on, and it's a massive one, AI. How exactly does AI act as a unique catalyst for Equinix beyond just a general increase in data traffic?
AI is driving growth on two fronts for them: the massive data needed for training and the speed required for inference. And Equinix is positioned as the crucial meeting point for what we call hybrid AI models.
Explain that. What's hybrid AI?
Enterprise data, the private, sensitive customer data that makes AI models commercially useful, is very often already sitting inside Equinix data centers due to security and regulatory rules.
Right.
Now, the massive public AI models run by the hyperscalers, they need to access that private enterprise data quickly and securely, but they can't move that data over the public internet.
So Equinix becomes the secure bridge. They sell the low-latency connection between the enterprise's sensitive data and the AI model's processing power.
That is the high-value transaction. It positions Equinix as this essential nexus for hybrid AI, where the core enterprise data is secured locally, but the heavy lifting of the AI processing is done through a direct, low-latency connection to the public cloud AI services. It just reinforces the need for interconnection at the edge.
Now we have to look at the bear case, the permanent impairment risk that could actually break this fortress. This is the really crucial part. We identified 3 major threats. Let's start with the most salient one: hyperscale disintermediation.
This is the argument that I guarantee you legitimately keeps the management team up at night. It is the fear that AWS, Google, and Microsoft, the three most capitalized companies in human history, could leverage their vast resources to build enough of their own connectivity hubs to bypass Equinix entirely.
They could stop being tenants and start being direct competitors.
Exactly. They use Equinix today out of necessity and convenience, but with basically infinite capital. They could eventually decide to internalize the entire connectivity chain themselves, hollowing out Equinix's position as the neutral middleman.
And what would that strategy look like in practice? How would they do that?
It looks like aggressively building their own mega campuses and laying massive amounts of their own proprietary dark fiber between them, and then offering increasingly attractive terms to their own cloud customers to stay within their ecosystem.
Like offering cheap data egress.
That's the key. Offering free or extremely cheap data egress, which is the cost of moving data out of the cloud, if the customer agrees to use their own proprietary interconnection points.
Yeah.
If they can build enough density on their own, the enterprise customer might no longer need to pay Equinix a premium to connect the two. They just stay inside the Amazon ecosystem.
And that would directly attack Equinix's highest margin business.
It risks reducing their core retail interconnection revenue, that high-margin toll road, to just being dumb pipes.
Yeah.
Just simple real estate lacking that crucial density premium. It's a very real threat.
Okay, that's a powerful one because it's driven by sheer capital. Let's move to the second risk. This one is more theoretical, but it's necessary to consider. Technological obsolescence.
Right, this is a low probability but very high impact risk. It basically assumes some sort of breakthrough in physics, that zero latency data transfer over long distances suddenly becomes possible.
Like through quantum entanglement or something we haven't even thought of.
Something like that. If physical proximity no longer matters, if you could put your servers in rural Iowa and communicate with the NASDAQ exchange in New York City instantly, then the entire NY4 location mode, which is built on the tyranny of latency, it just vanishes overnight.
It's a black swan event.
A total black swan, but when you have to acknowledge when you're investing in infrastructure that is built entirely on today's physical constraints.
And the third risk is very real, very immediate, and very localized. Power constraints.
This is a near-term operational reality check for investors. Data centers are incredibly power-hungry, requiring immense electrical capacity. And AI workloads are only amplifying this demand exponentially.
And the grid can't keep up.
In key high-demand markets like Northern Virginia, which is the world's most concentrated data center market, or Dublin, Ireland, the existing electrical grid capacity is simply maxed out. Dominion Energy in Virginia, for instance, has openly struggled to bring new power lines online fast enough.
So if Equinix can't secure the power contracts or permits to bring new capacity online in their most valuable cities, what happens?
Their growth in those crucial high-density markets could effectively grind to a halt. If you can't power a new facility, the fortress stops growing where it matters most. Now, they have mitigation strategies, long-term power purchase agreements, investing in green power, but the regulatory and infrastructure hurdles are immense and act as a serious drag on near-term growth in the hottest markets.
Okay, let's turn this on its head and look at some second-level thinking on the financials. The market consensus seems to view Equinix as a safe, steady grower, but one that gets hurt when interest rates are high because of its debt load. What's the contrarian insight here that people might be missing?
The contrarian insight is that the market may significantly underestimate Equinix's pricing power, especially during inflationary environments. We know inflation raises costs across the board: labor, materials, and most importantly for data centers, power costs surge.
And you'd think that would eat into their 45% EBITDA margins.
You would think so, but not necessarily. And here's the mechanics of the hedge. Equinix often secures long-term fixed-price power purchase agreements, or PPAs, for their input costs. So they lock in what they pay for power.
Okay.
But because of that Hotel California switching cost we discussed, Equinix is able to pass rising operational costs, including power, directly through to their customers almost immediately via their contracts. And they have built-in annual rent escalators on top of that.
So their customers are so terrified of moving that they just have to absorb the price hikes?
They simply absorb them. So Equinix has locked in their input costs with long-term contracts, but they maintain total flexibility and power over their output price, their rent, and connection fees.
So in an inflationary environment.
But in an inflationary environment, Equinix acts less like a victim carrying debt and more like an inflation hedge. They can maintain or even expand their margins during periods of rising prices because their cost structure is relatively fixed, while their revenue is highly elastic and basically non-negotiable for their customers. It's an inflation hedge disguised as a tech stock.
Finally, let's wrap this segment with the ultimate red team challenge. We have to articulate the strongest possible counterargument to the entire bull thesis. We are fundamentally betting on the middleman retaining his toll-taking power.
This is the critical dilemma. The question you have to ask is, why would the most capitalized competitors in human history, Amazon, Google, Microsoft, continue to willingly pay rent and interconnection fees to a neutral third party when they could, theoretically, become that party themselves?
They have infinite capital, massive scale,
Unparalleled software expertise to build the alternative. So if they can successfully build their own dense interconnection hubs and lure customers in with free or cheap data ingress and egress, they would systematically hollow out Equinix's premium valuation.
So we're betting against the strategic will of Amazon and Google.
That is the ultimate risk. The fortress is only secure as long as the giants feel it's strategically, operationally, and financially easier to rent access than it is to replicate the density. If that calculation ever changes, the premium valuation is in serious danger.
This has been a fascinating and incredibly detailed deep dive into the underlying architecture of the digital economy. Let's try to synthesize the core takeaways here. We're looking at a fundamentally irreplaceable asset, at least for now.
That's right. The ecosystem density, buttressed by network effects, and those Hotel California switching costs, they create what is almost a natural monopoly in key cities around the world.
And that's being reinforced.
It's being reinforced by disciplined management who's shown they can allocate capital rationally with the X-scale JVs, and they're riding this powerful secular tailwind of AI, which desperately needs high-speed, secure interconnection at the edge.
But the balance is crucial. We have to acknowledge that while this is a company of extremely high quality, it faces very significant structural threats. Hyperscale competition is the sword of Damocles hanging over that premium valuation.
And the debt load, while managed expertly, does mean that the macro environment of rising interest rates creates real pressure points on cash flow growth and asset valuation.
So the investment decision for Equinix, it really remains purely one of quality versus price.
Exactly. If you buy the quality at a disciplined price, letting macro fear create a window of opportunity history suggests the compounding returns will be powerful and durable. If you chase it when the multiple is stretched, you are leaving yourself exposed to those permanent impairment risks should that hyperscale threat ever really materialize.
And that leads us to our final provocative thought for you to chew on as you consider the future of digital infrastructure. We know that the physical infrastructure for the digital world, the Equinix network, is an economic fortress today. The question is this. If the biggest cloud providers are actively building their own private cities, their own proprietary fiber networks, and their own bypass roads right outside the main highway, how long can the owner of that main highway keep charging premium tolls before the drivers find a way around it?
So continue exploring the pace of internal hyperscaler interconnectivity builds, their dark fiber investments, their internal exchange points, and weigh that against Equinix's ability to increase its own network density and integration with enterprises through these high-margin platform services. That balance of power is what will dictate the future of the premium valuation.
That's all the time we have for this deep dive. We really appreciate you joining us for the analysis of Equinix. Until next time.